Hi everyone. The assignment for the course, okay, you pick up a publicly held company, because only publicly held company you can get data for. Point number one, I recommend to do in the end, when you already finished everything. That will be, you can call it introductory and summary. If you want to combine 1 and 6 together, I have no problem. Okay, you can call it introductory and summary. Sorry? Okay. Now, point number two is really show your understanding of the company. Okay? You can take it formally, do it like a SWOT analysis. You can talk about Porter analysis, and you can be a little less formal. Just show that you really understand the company. If you talk about, let's say, Amazon, so you really do know that Amazon has 3 major segments today. Okay? And you talk about their retail, internet retail, you talk about their Amazon Web Services, and you talk about their new venture that started the last 2 or 3 years about, the Go store they acquired for the whole food chain just to get into that business. And they have one, they were the first one, they have already, I think, 21 stores, which everything is automated. So you just show that you really understand the business of the company before you touch the numbers. Because I really do think that they do kind of combine. Knowing that there are 3 segments, automatically you will look more about information in the financial statements that might have to do with different segments. And I will talk about that a little bit toward, especially next time, about segment analysis a little bit. But if you don't know that, then you don't really, you're missing, even just looking at the number, it doesn't tell the whole story. That's the objective of number 2.
Can I ask something, please?
Sure, go ahead.
Can we use, like, for example, our personal knowledge, like if I'm doing about a company that I work in?
Definitely.
And I know, okay.
If you have the finance, if it's publicly traded, you will have also the financial.
Yeah, it's Intel.
Oh, that's perfect. That's the best, in fact. I would say it's even more. If you have a company that you have done already, what I ask you in point number 2, and you want to just take what you did in other class, you're more than welcome. Okay? The course is not really about SWOT analysis or strategy and all of that. The course is for the other analysis, but the other analysis do relate to what the company is about. So if you already have done a paper in another class and you already have it ready, you can do cut and paste. That's perfect. In fact, I will even encourage, so you will have more time to spend on the analysis, okay? Fair enough?
Okay, yeah, thank you.
Okay, wonderful. So let's go to the next part. Perform vertical and horizontal analysis on the balance sheet and the income statement. In fact, that's what we did last week. Just do it on your company. What do I mean? Let's be more specific. Let me open even another one here. You can just do exactly as I did. You have the balance sheet. You take the balance sheet, you have several years. Don't struggle to go 5 years. Even if you do 4 years, it's fine. Unless it's easy for you to get the data, okay? And then you take the data, you put it in Excel, and from this one, you derive this one. It's really a simple Excel function. You take, let's say, how I got the 0.99, very simple. I take the 8 divided by the total assets. That's the way I got the 0.99. I will put the dollar signs to lock the total assets, copy the equations all the way along. You'll get everything's calculated correctly. That's pretty cool. So that's easy, and then you copy it to the right side. You got the vertical analysis. That's on the technical stage. Then, technically, how to do the horizontal? Very simple. how do I take the 125? I simply take 18 minus 8, divide by 8. I will do it in the Excel, and then I got the 125. Same things. This time, yeah, you don't need to lock anything. So you just copy this one, okay? And you copy it all over. You don't really need to lock anything. You're done. Technically, you're finished. But what I really would like you to talk about, it's similar things we talked about last time, is the company has fluctuation in current assets. By the way, if you look here, if I look here, if all the numbers are 0, that means the company haven't changed at all. If I see everything is like 5%, it means everything is going 5%. Wow, beautiful. But it's already the case. We see here cash. We talked about cash about this company. We have 125. It's a big jump. That's a big jump every year. That's probably something I will ask. Is this really like similar to the industry or not? On the other hand, account receivable, there's a big jump here, and then it's flattening. Maybe there was something. Okay, but the last few years, it's quite stable. Total current assets, that's driven by the cash. Okay, so you can say total current assets going up. Why? That's one thing that you can think. And you can see this growth, it's really mostly because of the cash. We don't really see much growth in the inventory. It's quite reasonable. This one, other current asset, that might raise a question why there was a decline. It's only 1 year, okay? And then we will have 44. So, but nothing really special. I think the cash might attract attention in this example, okay? Then you do the same things. Is the company is growing? If I see a positive numbers here, that means the company is growing. So there is a shrinkage here. There's a growth. I can do an average of all those 4 years and say more or less what is the growth rate of this company over the 4 years. That could be interesting to say why. They will see a jump here. Maybe they acquired another company. That could be interesting. And that's the things that you're really supposed to do with horizontal analysis. Look at special numbers that seems odd, okay? How about the equity? Wow, we see total equity, a huge jump. This year, a huge jump. Okay, that means they probably had a lot of profit and they didn't distribute any dividend. We have another big year, and then later on, a small increase. Maybe they have a big dividend in that year. On the other hand, so I will look at the profit. Is there a big profit? Is that a big profit have been distributed? That gives me a lot of insight about the company. What is really happening in this company? Here we have a special line, subsidiaries. You can also choose my way of, and you can see if there's an account about subsidiaries. By the way, subsidiaries in consolidated financial statements will be embedded. That's what we'll do next session. I will talk about it. So if you, and what most likely you will have, is consolidated financial statement, you will not see most likely that line said subsidiaries. That's a topic for next week, okay? We'll talk about intangibles next week and what is special about patents, intangibles, and goodwill. What the difference between those three words that seems very similar, okay? Then you just talk about, you have the vertical, you can really get the same sense. Here it's helped you to compare 1 year to another, okay? You say relative, this is a little easier. Here you say that it's growing, but is it growing more than total assets? That's really what this one does, okay? If, keeping total assets 100%, if I see 5%, in 2005, the cash was growing by 5.7 more than total assets because this is hooked up as 100. So this is relative to the 100, and this is relative to the 100. So this is the growth of that year. So let's see. This seems fine. Okay, so this is a little helping, a little clearer to some extent. But you look at both of them together, you see total property, plant, and equipment as percentage of total assets is going down. Okay, so I can say let's say property, plant, and equipment. Here I have only 1 year as if it's declining and then it's growing. I can take an average, it seems positive. But when you look at it here, it's very clear it might not declining in absolute, okay, from 1 year to another, but it's definitely declining as percentage of total asset. Is this company, reducing property and plant and equipment? Why? That could be a question. So look at your company. That's something that I would like you to try to find out why, if there is a phenomenon like that. Here we see that actually that decline of about 5%, 6%, it really is an increase in cash, and that's probably cash can explain that. Why do they move? Removing property, plant, and equipment, how they became to be efficient. You can read a little bit the discussions of managers, give you a good opportunity to see how annual report looks like. Strongly recommend. That's a really good one. Okay, then we talked about, if you notice, this is really obvious here, that this company has a strategy to reduce total liabilities and definitely as a percentage of total assets. That's one very obvious, important strategy point that the company is doing. On the other hand, how do they finance that declining? It's by having a higher retained earning. You see, the retained earning is going up. And the reason it's going up, because they probably didn't distribute a lot of dividend. Okay? You'll see between those 3 years, the retained earning jumped substantially. Last year, it went up a little bit. Okay? So now if you combine it, let's look at the profit itself. We go to balance sheet, the income statement, we can see the complete story, because what increased the retained earnings is supposed to be the net income. And then we'll see the next statement, which we need to analyze similarly, or the same type of discussion. We have revenue, it's growing. We had a decline here. Remember we talked about it. So if you see a phenomenon like that, say if you were doing it around 2008, 2009, you probably will see a big decline. If you did the paper next year, then you probably will see a big decline this year because of the Corona situation. And the beautiful part, that's why I liked it, I built up this example, that although there was a decline, this company, you can tell they had a good management, because the cost of goods sold is declined even more. They have a good reactions to forces in the economy. Revenue is going down and then goes up. Who knows what happened that year, okay? And then, but their reaction was good. They even ended up making more profit this year than last year, just because they reacted correctly in all other aspects. So that's one thing you want to discuss. Secondly, you see net income going up, meaning what we saw in the balance sheets, the increase in retained earning came from the increase in net income. And that increase, it's probably most of the revenue, the net income went to increase retained earning. Besides last year, they probably distributed most of the net income and partially increased retained earning. That's a really good story on talking about it. You can use the same things, the same kind of feeling. You can use those two sets, talking about how is it as a percentage of revenue. You can say, well, cost of goods sold, good reaction. Say it used to be 76%. This year it went down. And not only that they reacted nice to what happened in 2003, they even kept the efficiency over the next few years. That means it was a permanent reactions to efficiency. That's a beautiful analysis. If you write it that way, that's perfect. But in your story, it could be other stories, many other stories that I said, but here I try to highlight how you can translate those numbers. Okay? Gross profit, big jump, 21, 20, 33, stayed above 30. Very unusual, beautiful. Net income as percentage of revenue, pay attention. This is all normalized, meaning extreme good profitability as percentage of revenue. this company is doing really well. Not only their operating profit went up, okay, it's also translated as a net income. The only difference between the two is net interest expenses. And here, what we see here, interest expenses going down. Then you ask yourself, why did it go down? And you remember when we analyzed the balance sheet, we said this company's strategy was to reduce
Paying
debt.
off.
Yeah, go ahead.
They were paying off debt.
Exactly. So if you're paying the debt, you're reducing also interest expenses, which is really nice. That's beautiful. Okay. Now we look at the last one. This is really just, this is the horizontal analysis. This is just really emphasizing changes. We have a huge change. We already talked about it. Okay. We have a huge, bigger, this is really a nice comparison. The revenue went down by 14%, but the cost of goods sold went down by 28%. Excellent reactions. And then, moreover, not only it didn't destroy the profitability, okay, we have a huge increase in net income in 2003. Beautiful performance, okay? That's really what I expect in the discussion of vertical and horizontal analysis. Then I talk about perform ratio analysis. That's the topic of the sessions today. And that will be the topic of next session. As we go over this one, I will emphasize what I'm expecting you to write about point 4 and point 5. And that's the end of the paper. Just so you understand what's happening. Now, I won't pick up everything that's going to happen in the company, but I will see if you have a good intellectual understanding of the financial statement, okay? So don't be afraid that you might miss something. Those companies are huge. There is so much going on. Get the big picture, get the big items, okay? Okay, any questions, at least up to point 3, 4 and 5, I will discuss as we go along. Questions?
I have questions.
Sure.
Is there any chance to get the Excel of the balance sheet or income statement from the company? It's like
you can take what I did here. You know, probably next year I will be nicer even. I just, you know, my time is limited. So that I'm not nice. It's, my time is limited. I wish I finished it. What I really would like to do next year, you know, I can, by the way, this year already it's a big jump to have that component. Next year I would love to add here, you see, right in the bottom, I'll write number 3. I'll give you an Excel, like similar to Excel, you just put the numbers there and you just even write your discussion in the bottom. It will organize the paper for you. That will be really cool.
Yeah, because the task to put from the another to the PDF to the Excel is cost a lot of time for us. It's 5 years of the balance sheet.
Exactly. So I tell you what I would do if I were you. Okay, and you don't really have enough experience analyzing financial statement. It's very reasonable. What I would do, I would go here to my spreadsheet. Where is it? And what happened? What happened? No, this one we don't want. I want this one. Yeah. What I would do, I would just take this one. You see that? I will copy the revenue to the Excel. This search all the items here. Okay, and then write 2020, 2019, 18, 17, 16. If you have 15, fine. If not, it's fine too. And then just put the numbers here. This one is really easy. You just copy exactly the same framework and just put the equation inside the Excel and move it. Sorry, I mean, copy this one first as it is, without the numbers, of course. You put it in the Excel, you just copy this one as it is, put the years 2019, go backward, and put the numbers right from Yahoo Finance. Go to, I would really strongly recommend download the annual report from the internet. How will you do it? just very simply go, or you go to just to the online. Let's say if I would write here, it's the Amazon, and you want report, and many times you will get there. It will give you which one do you want. Go to 2019. Okay, click on this one. I will take you right to their website. And here you should get, here we go, this annual report. You see, very simple. Most of the big companies have it. So here we go, you got annual report. Going to, usually what I was usually do, Control F, balance sheet. And sheet, and hope, no, it didn't like the word sheet. Maybe it's a one word. Let's see. Next. No, it didn't give me. So that's probably on the second. I would have it here. Here we go. Form. No, that's 10K. Yeah, that's okay. 7. No, that's not what I want.
It's item 8, financial statement and supplementary data.
Where do you see it?
Item 8, page 34.
Page 34. Okay. Yeah, here we go. Yeah, that should be it. Good. 34. Yeah, here it is. Beautiful. Here you have the data. Which one are those? No. Go. Down. Here we go. Here we go. Here you got consolidated statement of cash flow. Here you got statement of operation, meaning income statement. And here you got, this is the, in the US they call it the schedule, but this one, this is really additional comprehensive income. I didn't go into that much, and you can skip that one. It's really important for certain cases. There, you see, there isn't much here, but it's a whole topic, and that's really should be an accounting class. But, and here you got the balance sheet. So what I would do, I would try to take, let's say, the income statement, just pull the data from here and put it in my similar Excel, okay? Net services, and here we go. Total net sales, that will be my revenue, okay? It's the total of those two together. Then you have operating expenses, cost of sales, you got it, it's right here. That's a major number. That one I will put as a cost of sales, okay? Now, these ones, general administrative, put it in general administrative in mind. They didn't break it up this way here, but it's a very classic way of breaking down like the way I did. If you don't have depreciation, put 0 there. That's fine. You can ignore the depreciation. It won't make much difference, okay? Gross profit. See if you can really put it in this structure. It would be really nice for you also. Okay, and that's very simple relatively. You can go and follow the other things. Then you have a provision for income taxes. This is really the truth of the matter. This is the tax expense. It's not the actual tax they paid, but that's again has to do with accounting class. So you have all those ones, plug it in there, and then you just, based on this one, the rest is easy because this one is just a simple equation inside Excel. And this one is also a simple equation, and you're done. Some things for the balance sheet, okay? If it's easier for you, you can go to Yahoo Finance. They usually have, let's see, it doesn't like me. Yeah, what did I miss?
You missed the 8.
Yeah. So here you can go and just type Amazon. And here we go. And in fact, really nice. They're giving you a lot of stuff here. Where is it? Let me see, here we go. Financials. You go into financials. It's amazing how much information there is for free. You have here income statement, balance sheet, statement of cash flow. That's pretty cool. Most of the stuff here is really organized the way I organize it for you. So you can get the numbers right from here. That might be easier for you. But I do really strongly recommend at least once in your lifetime, see something like that. Look at it, flip, just go over it, see the structure for yourself, A lot of the stuff in knowing the company you can find here. A lot of at least once do it for yourself, even more than the paper. Read about a company, learn about it, see how it looks like. And you notice more than 50% here. It's not really accounting. It's not finance. It's general information. So, but for the paper, this can be really useful. Just going to Yahoo Finance, you got all they go back for usually 3 years. Yeah, I had that. Okay, they're blocking me here. So, okay, anyway, now here we go. You have up to 2016, that's fine enough. You have 4 years, pretty good. Okay? So you can take the data from here, plug it into that one, do the equations in the Excel, you're done. Then you just talk about the issue. By the way, you can see a huge jump. By the way, this is an amazing company. A huge jump of revenue from 1 year to another. Unbelievable. In fact, the truth of the matter, when you look at it, this is a really good company to analyze. It just, I don't like the see why I don't like, many times I make my own just because of that. Okay, if you look at this one, it's really amazing. Huge, huge, it's more than double in 4 years. Look at the net income. That's the EBITDA. I want net income. Anybody sees net income? Yeah, here it is. How much is really net income? Impressive. It was net income, used to be 2.3, it comes to be 13, 5 times more. Let's talk about the revenue, 136. That's about 2.5. Net income, more than 5 times. It's amazing. Now, then you can go into dive into and try to understand what happened. It will be really interesting to see what happened to gross profit as percentage of revenue. That can highlight, is it good or is it bad? Here I have 30% of 135. That's about 28%. Let's see the last year. 81, that's smaller percentage. So although they're selling more, as percentage-wise, it's going down. That's pretty interesting. Why? Is Amazon is real or is it a fake? It's nice that it's going up, but is it as a percentage-wise, is it going up as well? Well, we see it's going down. In fact, 81 divided by 321, it's about a quarter. On the other hand, 30 divided by 130, I think it's about 28. I just do it with my head.
Operating expense is decreased a lot year by year.
Exactly, that's interesting. But you can, it's true that the net income went up, but it's not a big deal. Don't be misled. It's after all, it's not a big jump. It's only 2.3 relative to revenue. It's a very small percentage. Look at it. It's less, it's about, I think it's 2% or at least less than 2% of revenue. Now, it would be really interesting to see similar companies. You go online and look for similar companies of the industries. See if you can find which industry is Amazon. What is common? If I will write, even let's say I don't really know where to find it. Most likely you won't know unless you have some experience. Common gross profit margin. I'll write Amazon. It doesn't make any sense what I just wrote, but let's see. Amazon can't latest 12 months gross profit margin is 40%. So that means in 2014, that means it went down. And then I will see if there's any discussion here. If I would be lucky, that would be really nice. If somebody compared them to others, I will click here. You know, that's your life, by the way. This is the modern life, okay? Revenue, gross profit, here we go. It does go up. That's the gross profit percentage. Margin means percentage. Well, you can see it does go up here and then it's declining. So I wasn't wrong. I did it in my head, but it does go down. See that? It used to be 41, it's going down. Well, is that means bad news or that good news? That's what would be really interesting to you can comment on it. So you can say, very interestingly, it's in 2018, let's say the last year and a half, it's almost flattened. It's about the same gross margin. But on the other hand, the stock price just rocketed, almost quadrupled, 4 times more than it used to be 2.5 years ago. Is that justifiable? That's a good question, okay? That's other stuff that you can really look and talk about by comparing percentage-wise. That's the vertical and horizontal analysis can help you. But this is a source, a really good source to look on analysis in Yahoo Finance gives you a lot of that, and there's a lot of other companies. You're at the age of should know how to search online. If you see in my, really, it's not coincidence, I put this guy's video in my website. I really believe in everything. You know, 7 skills a student needs to acquire. One of them is to know how to search for information. So this should be a second nature to you. But at least I'm opening up some of that, help you out to get like the 90% of what you need. Just do what I just did, you'll be fine. I strongly recommend, don't be afraid. Go search, love the company you're doing, and even study it because it might be a good opportunity for you. After you study it, you might follow it. And after you follow it, you might find interesting stuff about that company. If we will be lucky and you study options, you will see that if you study a company, if the company is good, it's good. If the company is bad, it's also good because you can go short. I don't know if you had a class in options, but there's no such a thing as a bad company, by the way, today. Anyway, I hope that gives you some hints on how to do, and you really take my advice. Do it for yourself more than for the paper. Do it for yourself. Okay? That's a good one, and this is a lot of good stuff to know where to go. This is a good structure to use. You can copy mine and just copy from Yahoo Finance and do the analysis, you'll be fine. Okay, guys, happy everybody?
Yeah,
Thank you very much.
You can't be unhappy because then you flunk the exam, you flunk the course. It's a requirement, prerequisite. You have to be happy. Good. So let's move to the next topic. And don't hesitate, you can send me an email, I will be more than happy to answer. Okay? So let's go into ratio analysis. By the way, we already have done some of the ratios. By the way, I had a discussion. I'm going to go over in fact, I put it here, but I'm going to elaborate in the class today, okay? So in ratio analysis, we have few categories. Those 4 categories are classical ratios. It doesn't mean it's everything. In real life, you might do many more, but you get the idea. Those ones are the minimum that you usually do when you're analyzing a company. We're going to go over each one of them. Then later on, we have some what is known as indicators. And this one, it's a bridge to our next session, talking about relative valuation, okay? So let's split this discussion to two parts. One is about classical ratios, and one about some indicators. Both of them coming to teach us what is the status of this company. So let's start. We have liquidity ratios that's supposed to tell me if the company is going to have any difficulties to pay their short-term liabilities. That's the objective of those ratios. Debt service ratios, those mostly is the company is sensitive to shocks in the economy. When company takes a lot of long-term debt, they might be sensitive and their stability might be affected. So if a company takes 95% debt, that could be really risky. If we get into a trouble like the corona, and a lot of businesses, that's what happened to them in the last year, and they just don't have enough to just pay the debt. And that's pretty bad. So this one is the short term, I would say. This is the long term, more effect. Turnover ratios is kind of a ratio that comes to tell me efficiency of operation. And we will talk about those two classical ones, one dealing with customers, one handling inventory. Then finally, we talk about profitability ratios. Is the company is really profitable? If somebody has good eyes, we already have talked about the first two. When we did the vertical analysis, actually we did the first two. Net profit on sales, that means take net profit, divide by revenue. That's we already have done it in the vertical analysis. Now, the higher the number, the better it should be. Something about gross profit, I mentioned it even for Amazon. Gross profit or gross margin is basically gross profit divided by net sales or revenue, okay? So those two were already, that tells me how much profit the company is doing as percentage of their sales. Last, it's really seeing the profitability relative to assets or the equity. This one is how much I'm profitable relative to the total assets. And total assets is really the total resources, the equity and the debt, okay, finance the company. After all, total assets belong to the equity and to the bank, the loans we got, or if we issued bonds to the public. This one is relative to the equity alone. And we're going to talk about those two together today. Good. So let's do those two first. Okay. And then we take a break and then we'll come and finish everything. Or we'll see. I think we can finish the first one and take a break. So how do I calculate the current ratio? Current ratio by definition, it's current assets divided by current liabilities. Okay. Let's look at my example here. Here we go. You have all that one here. And here we have these. We have all the balance sheets. And in fact, if you see those two is really taking current assets. Let's say I take the 30 here. Okay. And divide it. No, so the current assets, yes. And divide it by the 32. That should be my current ratio. Again, total current assets, total current liabilities. That ratio tells me the current assets. Some things I do for every year. And those numbers, I show them right here. So if you see current ratios, it's 94%. It's exactly 30 divided by 32 in percentage. Very simple. How do I get the 102? 102, I take the 18 divided by 45. That's the current liabilities. That one gives me this ratio. 102%. And the same is for the rest. Okay, I think this is technically very easy. The second ratio, it's quick ratio. It takes only the current assets, not including the inventory. It's the same things, but in the second one, we do not include the inventory. The important thing is, why do we do that? In the current assets, we're kind of assuming that all the current assets is available to pay the current liabilities in the coming period. On the other hand, might be that my company has inventory that's not always easy to sell, okay? So in that case, you know, inventory is not available quickly to pay current liabilities. And those companies, the second ratio is more important because current liabilities I have to pay. It doesn't matter what happened. If I'm not able to sell the inventory, I'm stuck. So just to get a sense, usually looking at those two numbers together give us a good sense if the company will be in a good standing in paying their debt in this coming year, okay? So again, first one is current asset divided by current liabilities, and the second one is exactly the same. We just do not include the inventory just to, this will be more conservative, yeah? That would be a lower ratio. And if this ratio will go below 1, I might be in trouble because I don't have enough current assets to pay my current liabilities. So I would like to see a company to have higher than 1. Now, should it be 2, 3, 4? Really depends on the industry. Some industries must have cash, otherwise they are in trouble, okay? You know, convenience store, most of the time they have a lot of cash. But if you go in utilities, let's say, you know, water utility, electricity utilities, all those companies don't really have to have a lot of cash. They might even have very small amount. And even if they have, they usually will put it in commercial papers to make some money out of the interest from commercial papers. So the other things I recommend, you can get extra bonus point. See if you have an Amazon, let's say if I was analyzing Amazon, how comparable companies, what is the ratio for Microsoft? What is the ratio for, let's say, Google? If you can compare those ones, that would be really cool. You know, it would be easy for you because you can most likely can get those ratios even from Yahoo Finance. So just go into other comparable companies and see if you can get similar and see if Amazon is higher than the other companies. That would be very good comparison. The next one is debt service ratio. As the name implied, we take debt to total assets. And the second one is debt to total equity. The truth of the matter, they quite correlate to each other because after all, what is really debt? You know, debt plus equity equal to total assets. So if I do D over E, okay, or I do D over A or over total assets, it's quite similar because you can write the second one, after all, it's a D divided by a D plus E. Or in another word, it's, you see, you can really, you know, D over total assets, you know, you have the D over here, so it's kind of very, you know, if you really want to be mathematically correct, you can say it's a 1 over, okay, 1 plus D over E. So it's really is the same. You know, if you do the first one or the second one, both of them is really a function. This is D over E right directly. This is indirectly a function of D over E. So the higher is this one, the higher will be this one as well, okay? So the lower this one will be, sorry. The higher will be this one, the lower it will be this one, okay? It's in the denominator. So they're really giving me the same information. So if you do one and not the other, nothing happened. Most common is the second one. This is what people usually use. That's debt to equity. But the first one is also indicative. So by the way, another name to this ratio, it's leverage. Okay, it's known in finance as the leverage. And leverage is total debt over total equity. Common description of telling me how much debt is really the company is taking. Now, as I said before, if you look in Israel, Israel, a good example of the Down Knell family, they have really collapsed just because they thought they can take as much debt they want. So they took a big loan, and even before the corona started, they went bankrupt. And all the IDB, they have to give up a lot of their holding. So this one, you can do it when time is good and you don't expect any bad time will affect you. Experience have taught us that companies that pass certain percentage, they eventually end up in a bad situation. It's true, by the way, even if for countries, you know, it's even for countries many times it's true. You know, countries that pass 80% of their GDP usually end up in bankruptcy. Anybody from Argentina? You probably know who is the champion of bankruptcy in the world. Who is the champion in bankruptcy in the world?
Argentina.
I think Argentina and Venezuela also is a good competitor.
Exactly, it's a good competitor. You're absolutely right. So if you analyze it, you can use it as a compatible country. Yeah, they are competing. In fact, Venezuela, I think even in a war situation, Venezuela don't have their own currency. I think it's linked to the dollar, the American dollar. Luckily, they are not as bad as Zimbabwe. They don't have any currency. It's supposed to be the true American dollar. That's a different class. Amazing stories. So you speak what? You speak Portuguese too, or what do you speak?
I speak Spanish, and actually I have a comment regarding your site.
Yeah.
You wrote in the corner Española. You should write Español because Española is a Spanish woman.
Okay, good. And you can tell I use Google Translator. So that's why I need people like you. I will do Google Translator and then you fix it. And you have also the English, so you can go back and forth and you can fix it. And by the way, you can do it online everywhere you are in the world. That's why it's a CMS. That's a
Yeah, I like your site. I hope that we will have access or even when we finish this course.
Yeah, thank you. And be in touch with me, any one of you. Anybody who wants to take a part of it, you're more than welcome. Just make me happy, succeed. Be successful, that makes me happy. So, okay. So leverage is extremely important. There is advantage for a company to have a big leverage. Okay, besides that they really can raise easy money relatively. It's tax purposes. You know, from tax point of view, when you pay interest, it's deductible for taxes. You know, so when a company makes a profit, the first things they do, they pay the interest. Whatever left on that, they pay taxes. And dividend, they're paying only after they pay taxes. So paying interest or paying dividend for the investor, it's better to hold it as an interest because if all the money, the profit of the company, if all the profit of the company was distributed as interest, the company wouldn't pay any taxes. Let's give an example. Let's say a company made, before interest, they made $100,000. The interest expense is $100,000. So all the profit gone as an interest. There's no corporate tax. Because income before interest, 100,000 minus interest, 0 income before taxes. On zero, usually you don't pay taxes. Hopefully, in Israel, they might change the rule. Okay, but okay, so that's advantage of interest. On the other hand, let's say the company don't have any loans. They're financed everything with an equity. I made a profit of $100,000. I don't pay any interest because I didn't take any loan. I financed everything as an equity. I have to pay taxes on all the other 100, on all the amount of 100. Only whatever left, I'll be able to pay as a dividend. So if a company is fully financed by debt, I can escape a lot of the taxes, corporate tax. On the other hand, if it's all fully equity financed, I will pay a lot of taxes because I can't pay any dividend before I pay taxes. In fact, even if I don't pay dividend, I still have to pay taxes on my profit. That's a very big difference between debt and equity. That's why companies like to finance their operation with debt to avoid corporate taxes. But in some point, this advantage could be really bad if you take too much debt, and that would be a big problem. So that's indicator. And every industry, as I said before, industry that have very well stable cash flow, it's a good candidate to take a lot of loans and take advantage of the tax benefit. But if a company has uncertain income or they have fluctuations in their income, they're better off finance it is equity. In equity, you don't have to distribute dividend, but on debt, you must pay interest. So the more fluctuations you have in the net income or the income before interest, the higher it is, okay, the more you want to finance as an equity, and the lower will be the ratio you would like for that company. Okay, I hope that really clarifying what the meaning of that ratio. Let's take the next one, which already we kind of mentioned indirectly, EBIT divided by interest charges. What do we mean by EBIT? If we go to the income statement, what is the EBIT? EBIT is operating profit. So let's take this here. If you see really the major account is interest expense, then you have taxes, then you have the net income. So the 260 has three parts. One is 120 for interest, goes to the debt holders, or let's say the bank. Then I have taxes, 25 goes to the IRS, and whatever left will be to the shareholders. So EBIT, you can think about it, has three parts: interest, taxes, and then net income. But the order is very important. There will not be any taxes if the interest will not have enough, it won't be covered by the operating income. One more time. If the interest was higher than 260, I will not pay any taxes and I will not pay any interest. On the other hand, if the interest is really small, I will have enough profit, and from that profit, I will pay taxes and I will pay debt. So the ratio of 260 to interest expense tells me how secure I am to get my interest paid. The higher it is, the better it is. So because I'm the first one in line to get my money, meaning the bank, okay? So out of the profit, the first thing that goes to be paid is the interest. So that's why we use this ratio. That's why we use this ratio of EBIT divided by interest charges, okay? That tells me how many times I can pay the interest. So if it will be 2, that's when I have a good buffer. Even if the profit will go down a little bit, I still get paid. And nobody else will get before me. So the banks love this ratio. It's called time interest earned. Times in the sense that the operating profit, how many times is of the interest. That's a good number for banks to look at. Good. You should really see it for your company. It should be more than one, most likely between 2 or 3. Okay. So that's a very important and gives me how stable is my loans and how stable I am in paying my loans. The next one is, as I said before, it's for operations, turnover ratios. One deals with account receivables, one deals with inventory, and both of them tells me something about management. Let's look at the first one. Account receivables turnover. How do we measure it? We take net credit sales, that means account receivables. Okay, sorry, that means cost of goods sold, my mistake. Net credit sales means one more time, sorry about it. I mixed up the two together. Net credit sales, it means really revenue in your case. This is the revenue. Theoretically, I should took whatever I sold in credit, whatever things you sell credit today. You sell credit cards and all of that, so you can consider it total revenue, okay? Although the definition is net credit sales, it's really referred to revenue. I take revenue and divide it by the average account receivable. What does it really mean? If I think about it, okay, let's take an example. There's another one more number that I will add that you might encounter in real life. Let's say my revenue is 120. Revenue equal 120K. Fair enough? And my account receivable on average, by the way, if you notice, we take the average of account receivable. Let's say my account receivable, it's 10. Now, if I told you, how many months of account receivable do I have out of the revenue? What do I mean by that? If my revenue it's over 12 months, that means I have 10,000 every month, isn't it? I start from January, February, March, etc. So I'm getting 120 because every month I'm selling 10,000. That's why I get the sum is the total of what I sell on average every month. So you can think about it. What happened? Yeah, I know why. I shouldn't, that's fine. I shouldn't put the K there.
The K.
You think it's a string. Okay, let's take it away. We mean millions or thousands, doesn't matter, 10. Okay, so I have 120. Now, the account receivable of 10, it's really like a month, isn't it? It's like a month of sales that I didn't collect any money. By the way, that has a name. Okay, usually you count it by days. Let's say 30 days of sales I haven't collected. So in other words, if I take revenue, divide by account receivable, I get 12, is that right? 12, it means 12 months on sales, okay? It means that 1/12 I didn't collect. One more time, if my sales is 120, it's really equivalent to, it's like 1 month I didn't collect. That's 1/12 of my sales I didn't collect. That's just making it more complicated than it really is. But it's really common that people say, well, you give me this account receivable turnover, nice, it's 12. The higher it is, that means I'm giving less credit, which is good. But some people like to translate it to days turnover, meaning you take the 12, you divide by, you take 1 divide by this one, and all of that you multiply by 360. That's common, you might see it. I won't kill you if you don't put it in the paper, that's fine. It's enough for me that you understand what is the account receivable turnover. That's pretty good because it gives me the same idea. It will give me 30. This is 30 days of sales that I didn't collect. Now the intuition is very simple. If I sell 120, that means every month I sold about on average 10. If my account receivable is 10, that means that 1 month's worth of sales I didn't collect, which makes sense. This is really 10 out of 120, it's really 1 month that I didn't collect. 1 month is translated to 30 days. If I counted, there's in a year 360 days. A really minor importance to this one, but just for you to know that some people like this number, and you might see it many places. Now, if we see the intuition, the higher this number, the better it is. That means I am collecting most of my sales. Okay, if this was 5, okay, that means my turnover will be 120 divided by 5. That's give me 24. 24, it's really like half a month. And that's really only 15 days. That's pretty good. That's okay. So the higher is the turnover, the account receivable turnover, that means that I don't really have to give a lot of credit to make sales. And the company saving money by collecting, they don't have to give free credit to customers. So the higher the number, the better it is, which can be translated to less days of sales that I give credit. Okay, that's one. That's really why we call it like an operation ratio. It's helped me to see if my product is really good. If the product is good, it sells by itself. I don't have to encourage customers by giving them 90 days credit or 60 days credit. Okay, most of the time I ask them to pair up front. The next one, it's the other side of it. It's how I handle suppliers. So if I look at this ratio, it's cost of goods sold divided by average inventory. What does that mean? It's same things. If I have my inventory is, let's make 20 just for the example. Let's make it, I don't know, let's make it 5. And my cost of goods sold, cost of goods sold, it is 200. That means that my suppliers not really giving me much credit. I'm buying a lot of inventory from them. No, sorry. I'm buying a lot of inventory from them, and sorry, I'll take back the previous sentence. I'm buying a lot of inventory during the year, but I don't really have to hold big warehouse. I don't really have to hold big warehouse because I have a really good relationship with my suppliers. That can be translated on small warehouse that I don't have to hold much inventory. On the other hand, if the situation was like that, that's pretty bad. I'm holding a lot of inventory. I'm not really buying that much relative to the inventory I'm holding. And why I'm holding a lot of inventory could be a lot of reasons. One of them be that my suppliers not really providing the inventory on time when I need it. So it's not really like the supply chain management that Walmart has. I don't know how many of you know, but Walmart have invested a lot of money to have a very good supply chain management with their suppliers. What happened is that by the time a customer pulls some product from the shelf, goes to the cashier, pays, immediately the suppliers know that Walmart in a certain store have sold their product, and they follow up of the inventory in the stores of Walmart. When it goes to below a certain level, the suppliers in charge to immediately supply that product again. Meaning Walmart don't really have to hold almost any inventory, very little. They can hold 2. That's pretty good. That makes them very profitable. So their shelves they can utilize their shelves to many more products than just holding so much inventory. So if this ratio of cost of goods sold relative to the inventory is high, that's pretty good. That means the management's handling inventory in a very good way. The higher is the inventory relative to the cost of goods sold, that's a 30, that will be less efficient, 6 times. That's not good enough, okay? Now, so those the 2 parts. One is how you handle customers, and the second one is how you handle operations with your suppliers. That's what the turnovers are about. By the way, there is something equivalent to days of account receivable. That's days of inventory. I won't even get into that. I won't even ask you to try to do it. It's enough for me that you talk about those 2 ratios, okay? How about I will make a small pause so I won't be so boring in one time. Anyone questions and everything's clear? Everyone want to say a joke just to make everybody awake? Because it really is boring, it's just information. But we have to know it, so that's life, okay? And the beautiful part is you hear it once, and then you have the formula, then when you're writing a paper, you just copy the formula, know what it means, and move on. Good, can I move on, Daphna? Good. Okay, I'm moving on. The next category is profitability, okay? So the first 2, I said that we already talked about them. One is net profit divided by net sales, and the other one is gross margin, just the name here I introduced, is gross profit divided by net sales. If you remember, when we did the vertical analysis of the income statement, we took every number divided by the total revenue. So here, gross profit is really nothing but taking the gross profit divided by revenue. So we already have seen it and we talked about it. Same things about net income. Take the net income divided by revenue. In fact, those 2 numbers already existed in the vertical analysis. So let's go now to the next 2, which are really interesting, very important. Please pay attention. The first one, I'm comparing the income for whoever financed the total assets. One more time, I'm taking the income of the ones who financed the company. Who financed the company? The debt holders and the equity holders. That's what we wrote before. Debt plus equity, that's total assets. Is that right? So what is the income for the debt holders? It's the interest. What is the income for the equity? It is the net income. Okay, I add those 2 together, that's the income on total assets. That's really what it is. If I take the total income divided by the total assets, that is return on assets. It really is. It's the interest plus net income for the equity holders. I take that total divided by total assets, I get return on assets. Now, just the 3 questions. You know what, I will hold on that. I will come after I will talk about return on equity, okay, in a minute. What is return on equity? In return on equity, it's even simpler in a sense. I look at net income and I look at equity. And the ratio, it's really return on equity. So if we look at that, this is return on equity, And return on assets, it's equal to interest plus net income divided by debt plus equity. That's really the definition of the two. By the way, and that's, I'll bring the question I had in mind a second ago. If I look at this one, I look at the interest rate. Interest rate. Okay, what is the interest rate? It is really nothing but the interest divided by debt. Fair enough? So I can look at it. We didn't really talk about it here, but just let's look at it here. What is the interest rate? It's the total interest divided by the total debt. What is the return on equity? It's net income divided by equity. What do we have in return on assets? It's kind of the average of those two. Because we take all the income and the net income divided by the sum of the denominator of both places. So if this one, let's just take an example. This one might be 5%. This one, let's say it will be 10%. Anybody want to tell me now, well, this one will be higher or lower than 10%? Let's wake up everybody. What do you say, guys? Well, the return on equity in my example would be higher or lower than 10%. Anybody?
Lower.
How about I give a bonus? A bonus is always wake up everybody.
Lower.
Lower.
Are you sure?
Yes. That's good.
Think about it. Interest is 5%. Let's make an example, okay? Let's make I equal, how do we do it? Let's make the simple one. I will be, let's say 5. I'll just write 5. And D would be 100. Fair enough? That's 5%. Here, I will make 10 divide by 100 as well. That's fine? Fair enough? At 10%, that's 5%. What do you think now? What should I do in the third one? I can put the numbers, don't I? Everybody? You can't get wrong. Let's just put the numbers. What do I put in the numerator? Which numbers do I put in the numerator? How much is I?
I is 5.
5, exactly right. So 5 plus 10, is that right? 10. And what the denominator? 100 plus 100. Make sense? That will be 25 divided by 200. That's higher than 10%. Must be higher than 10%.
It's 15. 15. 5 plus
15,
10 is
exactly.
15.
You're right. 15.
It's 7.5%.
You
So
know what? I confused everything. Now this one, I made a mess. I apologize. This one should have been here. I made a mess. I apologize. This should have been here in my example, and this one should have been here. Now it's fine. You're right. Fair enough? So everybody was right before, okay? If this one should be how much? 7.5. So always return on assets will be between the interest rate and the return on equity. Usually return on equity will be higher than interest. Very unlikely that return on equity will be lower than interest rate because the equity owners carrying most of the risk. So I will expect them to get a higher return. On the other hand, the interest usually, you know, the company have to pay interest, doesn't matter if they have profit or losses, okay? They will always have to pay the interest. They are first in line in bankruptcy. When a company is bankrupt, debt holders will get their money first. So that's why where the return on assets, which is like the average of those two, will be between between the interest and return on equity. Good. Let's move on to the next one. We finished, by the way. Yeah, go ahead. Anybody?
Professor, I have a question.
Sure, go ahead.
Okay, I want to know ROA and return of invested capital. It's the difference.
I didn't get it. One more time, sorry.
Oh, I want to get the answer about the difference between return of assets and return of invested capital.
Okay, very good. So I go over those three together and then we compare them. Return on assets, you take all the revenue, what it goes to the equity owners and as the interest. You divide it by the total assets, or how much is the value of the debt and the value of the equity. That's return on assets. So if you look at, let me open Excel, would be easier to show it. If I will make a balance sheet, looks like that. Okay, this will be, let's say, the debt. Let's say it's equal, in my example, take this example and do it with the Excel, would be nicer, I think. In my example, the debt was 100, and the equity was also 100. Fair enough. Total assets has to be equal to D plus E. So total assets will be equal to 200. So far, so good? Fair enough?
Yes.
Now, my interest was 5. And my net income was 10. So now it's really easy to see what's happening here. Interest divided by D, it's really is my 5%. Okay, 5 divided by 100, that means my interest, it's the return on this part. The net income divided by the equity, it's return on equity. It's this one. So this one is really return on equity, net income divided by the equity. This, the first one, interest, it's really my interest divided by total debt. That's giving me the interest rate. Now I said, so what is the return on the total assets? What I do is total assets, it's really is D plus E. It's 200. The same things. So what is the income for the total asset? It's the 5 plus the 10. So for return on assets, I take total net income 5 plus 10, divide by 100 plus 100, which is exactly the 200 here. So this is 15 divided by the 200, it is return on the total assets. On the other hand, return on equity is only net income divided by the equity. I hope that makes it clearer.
Yes, it's clear. But I want to know the return of invested capital. invested capital. It's usually evaluate the company about his cash flow, related cash flow, and his value, its value. So I do get this in the
Yeah,
cost.
hitting your question is wonderful. When you do evaluation, it's a totally different course, which I teach separately. It's in corporate valuation. What you do is you forecast the total cash flow that the company is going to generate from
Yes.
total assets. So that's
Yes.
stage number one. Stage number two, you don't use really the actual return on assets. You estimate what it's called WACC. This is just really a side note, not for your paper, not for your class. That's a really good question, so I will answer it. What is a
Okay,
WACC?
thank you.
WACC, it's an acronym for weighted average cost of capital.
Capital.
Fair enough? And let's put a C here.
Yes.
All right, what is that? You know, it's really supposed to be, you know, if a company is running okay, but there won't be any creation of value. But that's, as I said, a different class. But I just said the bottom line. See, that's what the return that we actually making on the total assets. When you look at your financial statements, you will calculate for your company this ratio. That's the actual. On the other hand, when I do a valuation of a company, I will try to forecast, first of all, forecast future cash flow. And
Yes.
then I will estimate how much I have to pay to the equity owner and to the debt owner. So if this one will be 7.5%, I will use this one to discount the cash flow. I don't know if you had a class in finance and you started discounting cash flow. I will use this WACC, which is a weighted average. It's the average between the interest rate on debt and expected return on equity. Okay, pay attention to the difference. Here, we take the actual, very similar concept. But here, we use, okay, instead of using actual, we use what we forecasting to pay the interest rate in the future and what we expect to pay return on equity. So if this one, return on asset, it's the actual average between those two, this one, it's expected average. And that's why you do that one in corporate valuation. So that's, you got the analogy. They're quite parallel in a sense, but one is relating to what have been done, and this is what the future is supposed to be. But they are very similar. This is slightly more complicated, slightly. When you account for the interest rate, you have to do adjustment for taxes. But as I said before, that's a totally different class. But your analogy was good, very good. More questions, guys?
Okay, thank you. I get it.
You're more than welcome. More? Okay, good. So now let's move on. Let's see if we finish the other ones. I think we finished all those four. We finished all those four ratios that we wanted. Now we have left with the bridge to the next section. Those are called indicator, and they give us, if you notice so far, we haven't used any market prices, everything we use is from income statement or balance sheet. Nothing has to do with actual market things. For example, P over E, it's really prices that you experienced in the market. In a minute, I will get back to it. Okay? That's very important ratio. The rest are, they don't really show. By the way, when I talk about dividend rate or yield, okay? By the way, dividend doesn't appear in a balance sheet and doesn't appear in the income statement. Is that right? Did you notice it? So we're expanding now those four ratios with other things that are outside of the income statement and the balance sheet. So that's one of the important things, why we call them indicators than ratio analysis. The ratios really relate to stuff that come from income statement or balance sheet. Okay, let's look at the first ratio. It's called earning per share. Is this number, first of all, let's see what it is. If I have a company like this company, we have net income was 115. And then I look at additional information and see how many common stock outstanding. That means how many stocks do I have outstanding? How many shares the company have issued? That one divided by that one, it is the earning per share. One more time, net income divided by common shares outstanding. Okay, let me just make a small qualification to that. In real life, okay, in real life, you're a little more elaborated. What do I mean by that? Sometimes, okay, a company issues shares during the current year. Many times they don't, but a lot of the companies traded in the stock exchange, they do distribute more shares, okay? They do distribute more shares during the year. So let's take this example. Let's say instead of the 2000, I would say, you know, between 2001 and 2002, they have issued 100 shares. So if I take 212 divide by 2,100, by the way, that's, I think, will be like one way to do it. But what more common to do is to say, well, profit was for 2002 was 112. And in real life, you will say, should I divide it by 2,100 or should I divide it by 2,000? Should I divide it by what I was in the beginning of the year or the end of the year? And the truth of the matter, the right answer is neither of them. If, for example, you issued the extra 100 in the end of March, that means the 3 months out of the 12, the company had only 2,000 shares. And 9 months, they had 2,100. So how much is on average? That should be the number. So if I do earning per share, I must calculate first the weighted average of share outstanding during the year divided, take the net income and divide it by the weighted average. So it will not be the amount that you take that one and you divide it by the end of the year or the first year, but usually companies report it in their footnotes and they will tell you how many shares were distributed during the year and when. And many times they do the calculation for you, just take the number out of there and report that as the earning per share. Okay, so let's go back to the definition. we have earning per share, income available to common equity, divide by weighted average of common shares. That's the meaning of weighted average of common shares, exactly like I did it here. Since I didn't give you that information here, in my example, I ignored it, okay? I should have said the 100 was distributed, let's say, by the end of March. It won't make a much big difference unless the company is really active in raising money. Stable company, usually it will be a minor effect. But most likely, companies that traded in the stock exchange will issue some amount of equity during the year. Just pay attention to the definition. I don't really ask you to go ahead and try to calculate exactly how they did it. Take the number as it's reported by the company. This is a number that usually companies report. This one divided by the weighted average, it's always reported. So for you per pair, just take that ratio. So I don't really ask you to go and try to figure out. You can just take this number from their financial statements. Good. Let's see the next one. Price over equity. By the way, before I continue, if I told you there is two companies, one company has earnings per share equal to 10, another company had earnings per share equal to 20. Which company is better? One more time. We have company A, earnings per share of company A equal to 10, and earning
It
per
depends
share,
on the base price, on the original price of the share.
Depends on the quantity.
one more time.
I say that it depends on the base price. If,
You're right.
for example,
It depends how many shares they have issued. If
And the
company
quantity.
B,
two,
if
got two.
company A has twice as many shares, then there's no difference. So if this company had, let's say, just 1 million shares, and this one had 500,000. No difference, isn't it? Both of them has the same earning. Because if I take this one times 10, that's the earning of company A. 500,000 divided by 20, that will be the earning of company 2. Does that make sense? Everybody got it? Those two companies has the same earning. So earning per share by itself doesn't really mean much. So be careful. Don't look only at the earning per share because it depends how many shares the company have issued. Okay? The next one come to take care of this issue. Now we have price over earning per share. E means earning per share really. So if company had, let's say I tell you this one equal to 10 for company A, let's say for company A, that will be, okay, for company A, and that's one for company B. Which one is better? For company B, it's equal 20. What do you say about each company? Anybody can guess? Any guess is good.
Company B is better.
Company B.
Let's think about it. What does it mean P? If you're buying now the shares, you're going to pay, let's make it, both of them has the same earning per share. Let's make it 1, just for the example. Let's assume E equal to 1. Just for simplicity, make the point. How will you translate now the fact that P over E is 10 and P over E is 20? Just talk to me like the way that my wife likes to talk to me, in money-wise.
It's overpriced.
So what is, oh, beautiful. So which one, see, Here I'm paying $20 to get $1 earning. Here I'm paying only 10. So which one is a better bargain?
A.
The first
A
one.
is a better bargain. Is that right? Because I'm only paying 10 for getting $1. You know, you can turn it around, by the way. In fact, I like, you know, formally P over E is there. But if you look E over P, which is the inverse of it, E over P has some meaning. This one is 10%. Is that right? And how much is it for company B? How much that will be?
20%.
5%. 1 over 20 is 5%. Is that right?
1 over 2.
Yeah, sorry, I made a mistake. Yeah, that's fine. E over P is 1 over P over E. So it's 5%. That's fine. So, makes sense? Now you can say, okay, what is E over P? Earning divided by the price I paid, it's my return, isn't it? E over P is really how much percentage I'm making on my money. So you can say the higher is the P over E, the less return I'm making. And that's not that good. Fair enough? So we would like, if we see a company with a high P over E, that could be scary. Maybe their price will collapse in the future. So we would like companies with lower P over E. Lower P over E, that means we're making a good return on our money. Okay,
Sorry, Professor. Excuse me, sorry for asking this, but are we finishing any time soon? Because I really need to leave.
Yeah, another 10 minutes, I'm finished. That's why I didn't take a break. And I will let you go a little earlier.
I may have to leave earlier then. I'm sorry.
Okay, no problem. Take your, that's fine. I'm recording the session so you can see the last 10 minutes.
Okay, thanks.
No problem. Okay, so now if we see, we have, so the higher is P over E, it might be an indicator of overpricing. The lower P over E, it might be underpricing. It might be a good bargain. Now, if you take a course in corporate valuation, you will see this is really not the whole story. Why is that? Let's say company A is expected to grow very fast. One more time. Let's assume company A is expected to grow very fast, much faster than company B. That would be even better. Not only I'm getting 10%, my return going even to increase in the future. That's really good. So company B will be really in a big trouble. On the other hand, if the story was the other way around, okay, it's true. On company B, I'm paying more for the same earning than I'm paying for company A. Then you say, well, maybe company B is expected to grow much faster in the future. If company B has a higher growth rate, maybe in the future, the earning that I would get from company B would be higher than company A. That would compensate me for overpaying. In another word, I might be willing to pay a higher ratio if I'm expecting company B to grow faster in the future. And that will compensate me for paying a higher price, okay? That's regarding to P over E. Some people develop the concept of taking P over E and try to fix it by comparing two companies by dividing by G. I won't get into that. Try not to do that, but that's for a different class, okay? That's really for a different class. And for now, it's really good just to realize P over E is very important, But if you're getting a big difference of your company to, you're getting a very high, then you say, yeah, why is it so high? By the way, if you look at Amazon, that ratio is extremely high relative to other companies. Whoever is doing on Amazon, it's quite high. Then you ask, why is it so high? Some people will tell you because we're expecting Amazon to continue growing much faster than other companies. And that's really the situation. Amazon is growing like crazy, more than double themselves in the last 4 years. So we saw the net income goes almost 5 to 6 times in the last 4 years. That company, some people will be willing to pay, and they do in fact, willing to pay a higher price relative to the earning. Okay, so that's give us indication regarding the POVE. Let's go to the next one. We don't have much really left, which is good. The next one, it says dividend rate. Basically, it's how much cash I paid as percentage, okay, of the market price per share. In other words, if in the first, if we look 1 over P over E, it's earning, here we look at how much dividend as shareholders have received as percentage of the value of the share. And one more time, dividend rate or yield, it means what was the dividend as percentage of the market value of the share. The higher it is, that means I got a lot of dividend, I got a lot of cash, and let's say I paid $10 and I got $1 actual dividend. That means I already covered 10% of my investment. That's really what this one does. The next one, it's a kind of, could be a good indicator if the company is still growing or they already got to maturity. It's if I see the annual dividend the company is paying relative to their earnings, one more time, let's say the company made a profit of 100. And all the 100 they paid in dividend. What that means? They're not keeping anything for investment. On the other hand, if they're paying only 50%, that means they're only giving back 50% of the profit and 50% they're reinvesting in growing the company. So on one hand, you would expect a mature company like Google, Google, some people will claim that are not yet in their peak. They have many years to go until they get to their peak. I would say Microsoft definitely getting to their peak, although some people might argue with me. If you take a company like 3M, which is one of my favorite ones, they're definitely in mature stage. You will see that ratio will be close to 1, maybe 80%. That means most of the profit goes to the shareholders, okay? And most of it's not staying in the company. Good. Last but not least, we have common equity divided by common shares outstanding. Another word, if I look at total equity, let's see here, we have in this example, let's say 2005, total equity is 877. I divide it by the number of shares. That should resemble how much it should be priced. Because what is really the number means? If I have 2,500 shares, the book value of the equity is 877. 877 divided by 2,500, that means how much every shareholders, one share in their hand, how much that's worth according to the books. Because the book says total equity, it's 877. If I divide it by 2,500, that's really kind of the value of that one share based on the accounting. And now somebody should ask, hey, how that relate to the market value of the share? Remember, we did here, when we go here, we divided P over E. Or if you look E over P, it's earning divided by the price. We have seen before earning return on equity. We had it here, return on equity. Here we took the net income divided by the common equity. Now put it together. This one really the book value of the equity. This is really, you can think about it, per share. But when I look at it, one hand I have, if I take P E over P, it's really the return based on the price. When I look at return on equity, it is really nothing but the earning divided by book value. Some things, I will leave it to you as a homework, okay? So let me, you know what, let me do it. And that will be important. I think it's important. With that, we'll conclude the session today. If I look at E over P, that's a return based on the price. When I take E over book value, that's really per share. Yeah, don't forget per share. That's why we're dividing the book value, total equity. What is that one? They're quite equivalent. This is really based on the accounting, based on accounting. And this one, return based on price. Now, what usually we see, prices are higher than the book value, okay? So most of the time you will expect this one to be higher than this one. But many people say, well, why do I even bother doing that one? And I would agree with them, okay? But and it's already any ratio. In fact, this is the return on equity. Return on equity is really this one, by the way. Many people will say, more important to me is 1 over P over E. This is really meaningful because that's what I'm investing in the company, okay? This one is a book value. It's less important. I will really conclude now. Usually you will ignore most of the time this one, although this one is exactly this ratio, return on equity. Many times when you really look at the indicator, this is really tells me if I'm really overpaying or underpaying. But there is one ratio that combine those two together is P over book value. What does that mean? If the accounting, the value of the accounting, the value of the shares based on the accounting, it's low and it's being traded for a higher price, this ratio reflects something. You know, why people willing to pay, for example, in this case, let's look at it, 2005. Let's look at the return on equity. Return on equity, it's, let's look at the book value. Do I have a book value? Yeah. Book value is 0.35. Book value is 0.35. On the other hand, the price of the share, it was given to be $2.01. So if I look at this ratio, you know, the P is equal to 2.1. And the book value was 0.35. Well, that means that people are willing to pay more than 6 times the book value. Why should a company would be willing to pay that? Anybody jump and then we finish. Anybody? Why would people will be willing to pay much more than what is really shows in the books? Anybody? I hope you don't have a class after me.
To gain control sometimes over a competitor.
Let's say I have a company. Make it real. I just developed a company. I invested in the company $100,000. I have only 2 shares. One more time. I invested $100,000 and I have only 2 shares, me and my wife. Well, you come to me and say, Amos, sell your share to me. That's what you do in the stock exchange, isn't it? When you go and buy a share from the stock exchange, what do? You're asking someone else to sell you his share. So you come to me and I said, you know what? I'm not going to sell it to you for $50,000. It's true that I invested only $50,000. Me and my wife, each of us, put $50,000 in the company. That's the book value, isn't it? Is that right? Whatever we put in the company. When you come to me 2 years later, I say, forget it. I'm not going to sell it to you for $50,000. If you want it, because it's such a profitable, and the accounting doesn't take into account that I'm an excellent manager. I have so many other intangible assets which are not reported in the accounting, as you learn in the accounting class. For example, research and development expenses, you most of the time expense them. But if I spend money on research and development, that means it's going to generate a lot of cash in the future. And you are willing to pay me above the $50,000 because you believe in the future you'll make more money than $50,000. So one more time, book value, it's a number based on only the accounting and only reflect the actual payment. It doesn't take into account a lot of other things that the company has. For example, if I have an excellent management team, it really not being measured anywhere. And people say, wow, look at Amazon. They have excellent CEO. They have excellent marketing. That's really much beyond that what the investor have put originally. So people are willing to pay for the shares much above what it is in the book value. So that's when we say they're willing to pay 6 times more than the book value, because like in the example I had in my site, they're willing to pay 6 times, like $2.10 relative to a book value of 35 cents, just because this company has excellent growth, excellent management, excellent patents. All of those are not reflected in the book value. And by the way, this one has a name called Tobin-Skew. Tobin was an economist, Chicago guy. So I have to mention Chicago guy. Tobin-Skew, it's not an economist really like that number and always look at it. It's kind of give you an indicator. If a company has a lot of intangibles, that could be an indicator that a company has many assets are not listed in the financial statement. It's not a ratio in, I didn't give it to you as a conventional indicator, but I thought it's a really good one, you know. If you look here, I even didn't put it here, but I thought it's a good knowledge and a good way to close our third session. We basically finished most of the stuff that I wanted. There is another, I would say 45 minutes to teach the relative valuation. And then I have to give you a present. I won't let you go without it. I will teach you about consolidated financial statements when one company buying another company, or when one company merging into a company. That's a really true present. I don't know if it's in this, I think I put it in the syllabus, so I make sure that I'll give you that present. But usually it's not part of financial statement analysis. That's supposed to be part of the accounting, but usually it's not being covered in introductory course in accounting. I think a student that's finishing MBA or MA in business school or whatever should really know that. So that's what we'll do next time. See, we finish on time.